Hi, this is Jeremy Kellett, Director of Recruiting here at Oakley Trucking, and I'm your host for this podcast. This is episode 88. On today's episode, we're going to talk about whether or not you have enough money to retire. And hopefully you do, but if you don't, how to get there. Specifically, if you're an independent contractor. We're going to talk about things you can do with your money that would help you be financially independent and feel confident that you can retire comfortably. That's what it's all about. And I say we because I had to call in a professional to help me do this. So I've got Scott Inman with GenWealth Financial is going to be with me and talking about this stuff for all you independent contractors out there. But first, let's do an Oakley update sponsored by Arrow Truck Sales. Keith Wilson at Arrow Truck Sales in Springfield, Missouri is currently offering $1,000 off your first month's payment when you finance with transport funding, or $1,000 off the truck price if you bring your own financing. They're also discounting the cost of an extended warranty by $500. Arrow Truck Sales has been a long-time partner with Oakley Trucking, and that's because they specialize in first-time truck buyers. They don't do any leases. They have the best used trucks money can buy because used trucks is all they do. They don't sell any new trucks. And the biggest reason that Arrow and Oakley are partners is service after the sale. It is very important to us at Oakley that when we refer you to a company, that they are a good company with good people. They do what they say, and they understand our requirements. So give Keith a call at 573-216-6047 for a good used truck and tell him you heard about it on the Oakley podcast. So first on the Oakley update, I know it's a little bit early, but I want to talk about the Mid-America Truck Show. So this starts in March 24th through the 26th in Louisville, Kentucky. And as all you guys know out there, we haven't done it in a couple years. They canceled it, and this is a huge show in Louisville, Kentucky that truck drivers come from everywhere. And I want all you guys to be there if at all possible. So make plans to attend that. We're going to be there. We're going to have a big showing at there. I tell you what I really like is for some of our owner-operators to get in that truck beauty contest. Get those, that I know it takes a special person to do that, but if you're interested in getting in that truck beauty contest, we'll sponsor you. Oakley Trucking will, and we'll make it worth your while, but it takes some dedication now to if you've ever been to one of those truck beauty contests, I mean, they know how to clean a truck and a trailer, but we'll fix you up best we can too. So let us know if you want to do that. Also on the Oakley update, I want to acknowledge one of our owner-operators that has been here a long time and has stuck with us through thick and thin. He has seen it all since the very early days of Oakley Trucking, and that's Raymond Carnes, also known as Whippoorwill from Austin, Arkansas, right here local. He's been with us 32 years this month. And I was talking to guys that used to dispatch him, actually Kobe and Jason, they used to dispatch him for years, and they said, Raymond is just a great guy with a great attitude. He gets the job done. Raymond's getting on up there in the years. He probably wouldn't, want me to say that, but Raymond's not going to be listening to this. Trust me. If anybody knows Raymond Carnes, Whippoorwill, he's not going to be listening to a podcast. But he might, they said he's just a hard worker, great guy, great attitude, and grows a great garden. So how about that? Raymond, we appreciate all the 32 years you've been with us, and you do a great job for us here at Oakley Trucking. Okay, Mr. Scott Inman, it sure is good to have you with us today. I appreciate you coming over.
Well, I appreciate you guys asking me.
You bet. Give our listeners a little bit of a introduction of yourself, so they've got you got a little credibility here of who's giving them some instructions today, please.
Yeah, well, it's kind of interesting when you ask for a little background. How far back do you want to go?
Yeah.
Right? I mean, that's I spent a long time not being a financial advisor.
Right.
My background here in Arkansas is I was a television news broadcaster. I anchored the 5, 6, and 10. News in the evenings for KATV Channel 7 for about 13 years. Worked there overall for 17 years. I started in sports as a weekend sports anchor. But in 2016, I pivoted, and that was a pretty hard pivot from being a television news anchor to becoming a financial advisor at GenWealth Financial Advisors. It's a company in Arkansas, independent financial services firm, started and headquartered still in Bryant. We're kind of moving that, I guess, to Little Rock now, but we've got offices all over the state of Arkansas in West Little Rock, Conway, El Dorado, Hot Springs, Bryant. We're in Northwest Louisiana. We've got an office in the Bossier City area, and we just opened in 2021 a new office in Middle Tennessee. We're in Brentwood, Tennessee, which is a suburb of Nashville.
Right.
So it's a growing company. I kind of got in on the beginning of that rapid growth about 5.5 years ago, and have been working with clients ever since.
That's great. That takes that's a big decision to leave something like you were doing for so many years. You transfer into a different, all different business, but it looks like you're doing great with it.
Well, I can tell you that it was not something I thought I would be going towards. I knew I wanted to do something besides TV. A lot of that was driven by my family situation at the time. I had young kids, and they were involved in a lot of activities, and I had to work the 5, 6, and 10 news. As much as I tried to get them to record it, we had to be live, right? At 5 and 6 and 10. So if there was a band concert or a soccer game, I missed it. And, and that wore on me. As a father. So I was looking for different avenues and explored several of them, and I ended up getting into contact with John Shrewsbury at GenWealth. And John, who's been a financial advisor for, I think, 3 decades now, but when he was in his 20s in El Dorado, he was in broadcasting.
Oh, okay.
Okay, so he kind of saw, I think, a little bit of himself in me, and I have learned, just like you've probably learned doing this podcast, that everything is a communications job, right? Yeah. You just have to kind of learn what you're trying to communicate.
Right. Yeah. You know, it's amazing how many people in the communication business that you learn, you know, over the years meeting different people. So, you know, that actually seems a little bit for you to want to be away from your kids. I mean, not want to, but you were away from them. You wanted to be with them and see more of those soccer games and stuff. You're right along the lines of a truck driver at that time because, you know, the guys here at Oakley, they're that way. They miss a lot of stuff during the week, and we do try real hard to get most of them home on the weekends. There's some of them that stay out however long, but you know, they miss a lot of that stuff, and that takes a toll on them. So it's very important home time for these owner operators and truck drivers at Oakley to try to get home as much as possible to see their family. That's a big part of what we do. But also is a big part is the financial aspect. I mean, to me, these owner operators here, they need good advice on finances because they make a lot of money. You know, and when you make a lot of money, you're going to get overwhelmed a little bit, and you need to be saving, especially if you have your own business. So just to kind of give you a heads up on what's going on here. So a lot of our guys, all our guys are independent contractors. Some of them have their own business name. Some of them don't. They just go by their own name. Some of them incorporated, some of them LLC, and, you know, that's a whole nother a podcast episode there of LLCs and incorporation. But what I really want to talk to you about and get pick your brain a little bit is what some of the basic steps these owner-operators need to do because they're making a lot of money, especially this year. They're making a lot more than normal. What do they need to do to prepare for a good retirement? And, you know, just simple stuff that they can do, but also important stuff that they need to be doing because – I don't know, you know, a lot of people I don't think, Scott, think about retiring. I think a lot of these guys, they're going to work as long as they possibly can. And, you know, I think that's just because they're going to have to. We don't want that. I mean, people want to have a good, you didn't call it retirement. You call it.
We like to call it financial independence.
Yeah, there you go, financial independence.
Because what that creates, you know, I think retirement is a word that, it can be a negative connotation. Now, there's a lot of people out there that when they work and they reach retirement, they're excited about it. But retirement can kind of sound like you're stopping everything you used to do. You're done, right? Yeah. You're going to sit on the porch and drink lemonade or iced tea or beer or whatever it is, and you don't do anything. And financial independence can mean there's a day that if you've planned for it, and that's what we plan for, knowing that you have enough income from your investments, from your assets, to last you the rest of your life. Now, that may not mean you stop working. You have reached financial independence, but you may not retire, right? You just know that you work because you want to at that point. And that's really what we try to plan for with our clients. And I think I don't think truck drivers are alone in this. I think I've found that most people don't really think about retirement. It's hard to visualize what life's going to be like when you're 65, 70 years old, when you're 30 or 35 or 40 years old, right? I mean, you're dealing with the here and now. We mentioned the kids. I mean, you're going to the soccer games. You're trying to prepare for their lives, buy them clothes, get them to the school functions, make that house payment. I think the first piece of advice I would give is, and this is a word that nobody's going to want to hear, you got to have a budget. You got to have a family budget.
I knew you was going to throw that word out there, man.
I mean, my dad told me, this is not financial advice. Well, it is financial advice, but it comes from my father. I mean, he said, you'll never get ahead in life unless you stop spending as much as you make. You know, you have got to create some, we call it margin, to where you know, and you know what you've got coming in on a monthly basis. And I know that can vary, but you have some kind of idea of what your expenses are, and then even some discretionary spending, and it does not reach anywhere near what you're actually bringing in, because you've got to create the margin if you're going to put money away for later.
Right. So you don't. That's the thing about it. You don't want to spend all your money, because these guys are getting a lot of times gross pay, so they're 1099, so they're getting all the money, and they're not. They've got a plan for themselves for taxes and all this stuff, expenses that they have, truck expense and things. So they, typically I think a lot of guys will have a trucking account. Right. Okay, let's put money in this trucking account, and that's for the truck. And then here's the home account, that we got to do. And then they got a plan. I mean, that takes a lot to figure out, planning how much money. Then you got to set up an account for retirement.
Right.
That I think you got to be intentional somehow to do that.
Yeah. And I think people are probably they may be a little lost on what to do there, because when you're talking about an independent contractor, for someone who's a W-2 wage employee, if they work for a corporation or a large business, they're likely going to have some sort of retirement account that's offered through their employer. Whether it's a 401k or if it's a smaller company like GenWealth, we have a simple IRA that is offered, and we automatically, once we sign up, we put a percentage of our income before it ever gets to us. So it's just like it's withheld for taxes, right? The taxes are withheld for us out of that W-2 income. That contribution gets sent out before it ever hits our bank account. And that makes it easy. There's no question. Plus, you have an employer match, and that makes an incentive there for the employee.
Yeah.
An independent contractor doesn't have that, but that doesn't mean there aren't options. And there are options available when it comes to retirement accounts that will even help them on their taxes. And I think that's something that probably they need to realize first and foremost, that even if they don't really get in tune with their retirement side, they sure will get in tune with their tax side, right? Because they're paying that every year. And I would start there by saying, even if you're just a 1099, if you don't have the business entity created like an LLC or an S corp, you can create a SEP IRA, and that is basically when you think about
a SEP
IRA, SEP, Simplified Employer Pension, I believe is what that acronym stands for. But it's a SEP IRA, and it's easily created with one form through the IRS, and there's not a lot of red tape, not a lot of hassle. You can create that, and then of course you could have that account through GenWealth. You could have it through any, if you know somebody who's a financial advisor, they can help you create it. But what that allows you to do is, as an employer, because you are, right? You're both the employer and the employee here. The employer makes a contribution for you into the employee account. So you're getting the benefit of both sides, right? The employer makes the contribution, and it is a tax-deductible contribution from the employer side, and the employee gets the contribution into a retirement account for later, and it is...
What's the maximum amount?
So on that, the contribution is 25. The employer contribution. Again, there's no employee contribution here, right? So it's the employer that can make it. It can make up to 25% of the income of the employee. So it depends greatly on what you pay yourself, if there's an LLC and all those things. But 25% of your income up to a maximum, which I think is like $55,000 or something like that. So you can get quite a bit in there if you are paying yourself a lot.
I was reading some stuff this morning. Is that the same as a solo 401k?
Nope, that's going to be different.
That's different.
Yeah.
Okay.
So on the solo 401k, and that's an option too for someone. And the main thing there is the solo part, because if you want to create a 401k and you want to create a solo 401k, you don't want to have any other employees, right? So it works well for people who are in business for themselves and they don't have any payroll to meet.
Which are these guys?
Right.
I mean, they're an employee of themselves. So
right.
What about if they're? I'm sorry, I didn't mean to.
No, it's okay.
If they're incorporated.
Yep.
JK Incorporated is my business, but I'm paying myself in so much a year as an employee.
Right.
Is that? that's not different. I can still do the solo 401 or this SEP IRA.
You can do both, yeah. So,
Okay.
the SEP IRA in that scenario, if you have a business and you're paying yourself an income, then the limit, the maximum contribution you can make is 25% of whatever you're paying yourself. Okay, on an annual basis. On the solo 401k, there's a little more, we'll call it red tape involved with that, but that is not as easily created. You do have to have someone who is going to be your record keeper on that because there's a little bit more that goes with that. There's going to be a little bit more expense than there would be creating the SEP IRA. So when you say easy, the SEP IRA is clearly the easiest route.
Okay.
But the solo 401k, you can get more into it on an annual basis because now you can put in from the employer side and the employee side.
Okay.
And the employee side is the maximum contribution is just like a regular 401k. So if you're under 50 years old, this year it was $19,500. Once you are 50 or older, and that can be the year you turn 50. So if you're turning 50 in 2022 and you wanted to start this, you get a $6,500 catch-up contribution. So add $6,500 to the $19,500. So you're looking at about $26,000 you can get in on the employee side, and then the employer can make a profit-sharing contribution as well. So there's a maximum on that too, I think, of like $58,000 collectively. And you can actually have a SEP. I was actually just doing this for another client. You can actually have a SEP and a solo 401k, but the aggregate maximum that you can get into both is $58,000
Okay,
a
so
year.
so the SEP IRA, that's one of the easiest things for an independent contractor to start.
Yeah, there's just a lot less hassle with that. I mean, I've done both for clients, and I can just tell you through experience, the SEP IRA is, I mean, you put your name on one sheet of paper. It's an IRS form, but oddly enough, you don't even send it to the IRS. You just have to have it.
Yeah.
And then you have an account application and open that SEP IRA through an advisor. And then you can actually choose your investments. I would certainly suggest that you work with an advisor to do that. But
Well, and that's something I was going to say too. That there's being an independent contractor, you need to get with somebody like you or whoever it is, a financial advisor that knows this, that does this every day. For me, example, I'm simple. I need something pretty simple for me, so I'll just do a monthly contribution to my financial advisor, every month, and then he'll stack it up or whatever. He can keep it till it builds up to a certain amount, and then he knows and gets with me, hey, this is what we need to do with this, invest this smartly.
right.
And I think that takes a load off my plate, and that's what I would suggest owner operators, whether you're young or old, you start a monthly investment, an amount that's going to a financial advisor. He'll set you up an account, I'm sure. I don't know, is there a minimum, like somebody needs to say, if a truck driver, one of our owner operators called you and said, hey, I want to set up an account with you, Scott, is there like a minimum they got to have? Or
Yeah, I think so. Financial advisors tend to lay out their own minimums because obviously they're compensated based on roughly the amount of assets that they manage, right? So the more that they manage, the more they're compensated. So they may impose an account minimum at their firm. Now, at GenWealth, we do not. So there is no minimum to open an account. The only minimum that would come into play is some of the particular or the specific investments that we want to buy, like a mutual fund, let's say. If you're going to buy a mutual fund, a lot of those have $1,000 minimum to buy, right? So if you're only putting $100 a month in, we may have to wait a little while to get to $1,000 so that we can buy something. But there's no minimum to open the account.
Great, that's great, because that makes it simple, I think, to start. Start somewhere.
Right.
How? Is it ever too late to start?
No, it's never too late. I do think, to your point, if you're young, if you're in your 20s, if you got some 20-something truck drivers and you start putting back even that $100 a month. I have a 21-year-old son, and we've got a Roth IRA, and we can talk about that too. Those are retirement accounts. They're not necessarily specific to independent contractors or business owners. Anybody can do that with earned income, and I would say that that's a possibility too. But we opened a Roth IRA for my son when he started working at Chick-fil-A. Okay, so he started working at Chick-fil-A. He had earned income, and that's the only requirement to open a Roth IRA, right? You have earned income, and you can put up to, if you're under 50, you can put $6,000 a year into a Roth IRA. And while I'm on the subject, we'll just go ahead and describe what that is. That's going to be after-tax money. So in an independent contractor's case, I guess everything is, well, it's really technically pre-tax, but they've got access to all of it. You'd put it in after it's hit your bank account, and then you don't really claim it on the tax return at all, but it grows tax deferred and then is withdrawn in retirement tax free.
Yes.
So that's a huge bonus.
Yes.
Particularly when you think about where tax rates might be when you actually get to 65. If you're 30 years old now, or if you're 25 years old, they're likely going to be higher. So you get that tax-free income in retirement. So that's what we started doing with my son, and he started with $100 a month. We're up to $200 a month now, and you can look at a projection or an illustration. You can probably find it online. You don't need me to give it to you. But, I mean, if you do that, just that, from the time you're 20, 21 years old to the time you're 65, you got $1 million or more.
Yeah.
I mean, there's no guarantee of that, of course, but with the historical stock performance looking over time, if you get just a 7 or 8% annual return on your investment and continue to do it, the key is starting early and never stopping, you're going to create wealth for yourself. And there is I say this all the time on our show, there has been no better or bigger wealth creating mechanism in human history than the stock market.
Right.
It works while you're not working.
Yeah.
And that's where people kind of fail to realize that sometimes because they're fearful of it.
Yeah, and to me, it's a no-brainer. You think of anything else to invest in, just about, it's going to take your time.
Yeah.
Time and effort to manage it, maintain it. I mean, you just invested in the stock market, and yeah, you pay somebody to do it, a fee, but man, it's you don't have to worry about it. You look in it every once in a while, and it's great. And I mean, I know the hard part is the downfalls, and they're coming. They've been here. We've had them. People freak out over losing all that money and thinking, well, they could have saved it, and if I just had it in savings, well, you wouldn't have had that much money, because it wouldn't have made that much money. So they're real fearful, I think, and none of that. But boy, to me, the key is patience. I mean, you just have to be steady, putting it in there. Don't worry about it. As long as the only factor is if I'm fixing to retire tomorrow.
Right. That's different.
That's a different scenario you kind of got to do. So,
well, on the topic of volatility, and that's the word we would use. That's the big word for financial advisors. It's going to go down. Well, volatility really means it goes both ways. It's going to look like the cardiograph, right?
Yeah,
it's going to move all over the place. But if you're putting money into it and it goes down, well, let's think about that. You're buying shares of whatever you're buying, right?
Yeah.
And if that share price is $10 a share, but then it goes down to $5 a share, and you're buying it, that's like going to Sam's and getting it half price.
That's right.
Right? I mean, you're buying shares at a discounted price than it was yesterday. So it's a buying opportunity when the market goes down. And if you continue to do that over time, especially on what we would call a systematic contribution, automatic, monthly, however you want to say it, if you're putting it in monthly, you're going to catch some of those downturns over a 20 or 30-year time frame, and your overall return, if you do, is going to be greater than if you put all your money in at one time. That's called dollar cost averaging. It's a concept that, again, no guarantees that that's going to work out for you, but it is over time likely to do so based on what the market has done in the past.
Yeah, because you're steadily putting in. So when it's volatile, dips, then you're steadily buying and putting in. I mean, that's the thing with the stock market. I think you just got to have patience, be diligent of putting in every month, whatever you're doing. Don't worry about it until I'm fixing to take it out there tomorrow. I'm fixing to what I call retire. That's another situation there. But what is so we kind of touched on what a young man needs to do. What about a guy closer to retirement right now? I was actually in here the other day. One of our owner-operators are in here, and I was actually telling him I had a financial advisor coming. We're going to do a podcast. And he said, man, I wished it wasn't too late for me. And I'm like, you know, and it made me think it's probably not, you know. I didn't know how old he was, but I'm assuming, you know, a lot of probably the average age here is 55 plus. What would you tell somebody that hasn't started planning for retirement? What can they do to still have, you know, financial freedom, I guess, in the end?
Yeah, I think the only person that we really can't do much with is someone who comes into our office and says, I'm retiring tomorrow. And there's no way you're changing my mind, right?
Right.
If your retirement date is set and you're walking out the door, then you got what you got,
Yeah.
right? There's not a lot we can do about it. But if you have 5, 6, 7, 8 years, there's still time to do something about it. I think the biggest value for me, I've got 4 kids, and three of them are over 18 now, and they're all in college. I'm helping with that. I've got a strain on my financial budget, but there's a day coming. I can see it, right? It's not too far off. Then I'm going to have a lot more spendable income because I don't have the kids in the house. And so we do work with a lot of people. When you get to empty nest land and you don't have as much expense as you once did, maybe you get rid of a mortgage, or maybe you refinance and your mortgage isn't as large as it was. If you've created some margin in your 50s, even if you haven't even started, you have the ability you probably didn't have in your 20s, which is to pile more money into that. And, you know, we've talked about all these contribution limits in these retirement accounts, but don't think that that's all you can put into the market. I mean, you can always go into a non-retirement account, which is an investment account that has no, we call them, they're qualified accounts and non-qualified accounts. A qualified account just means there's a qualification to it. So it's usually a retirement account that if you take out before you're 59 and a half, you're going to get penalized for doing so. Yeah. But a non-qualified account or a non-retirement account, there's no penalty for taking money out tomorrow if you put it in. So there's really unlimited, it is unlimited, the amount of money you can get into the market. So think about that. If you can put more in than you could in your 20s, then you can catch up, right? They call it a catch-up contribution. Right. There are some catch-ups to be found there. And then when you get to retirement age, you're going to have Social Security if you've worked all your life. If you have a spouse, you're going to have Social Security. So what we do is we build a retirement income plan for our clients who are walking into that stage of life. So it is a combination of their Social Security, if there's a pension in play, and their retirement assets or any investment assets to create a monthly income stream. So when you think about what's too late for me, if you have 5 or 6 or 7 or 8 years to do something about it, and you get with a financial advisor and build a plan that can show you, if I save X amount and it gets X amount of growth over the next 6 years, what am I going to end up with when I walk away? And if that's not going to get me the monthly income that I need and want, then maybe I work 2 or 3 more years. Maybe I work till I'm 67 instead of 65. All of those things are variables that can be put into place using software and a financial advisor's expertise and build you a plan to let you know. I mean, the question is, if you really think it's too late, well, it is. If you realize that it may not be, and you go find out and get some more information and get a written plan in place, you can see what your options are.
Well, and some people may have more than they think. Here's, you know, I
That's
guess
true.
you got to lay out your assets.
Yep.
And your debt.
Yes.
You know, so how does that stack up? Well,
yeah.
Of course, we all know being debt-free creates a lot of freedom there to do stuff with, you know, money instead of paying it. But I guess they need to, you know, I would take that in consideration. Well, here you got, I don't know, a home that you almost got paid for, and you know it's too big. Maybe you need to downsize.
Right.
It's just them two now. Maybe that's an option, you know, and taking some of that money from that you had left over from that sale, you bought you a new place, smaller, then you invest that money.
Yeah.
You know, I guess would be something to think about. They may have more money than they think. They just have to sit down with somebody and say, here's what I got, and I'm ready to quit.
Yep.
What do I need to do?
Well, that's a great point. One of the most common questions we get early on in a meeting with a client is, how much do I need to retire, before we know anything about them, as if it's a magic number, right?
Yeah.
I mean, I need $1 million. And so think about the people who think it's maybe too late for them. Well, I don't have $1 million. Well, maybe you don't need $1 million. It's all about income needs and wants in retirement. So to your point, if the mortgage is there, then that client is going to need more income than the client who doesn't have a mortgage, right?
Yep.
So it's all about the income planning, and then we reverse engineer back into, well, how much do we need to make that happen? And we have clients that retire on $400,000, $500,000 and have a great retirement because of their guaranteed income sources they may have, like a pension. They may not actually have to have a lot of monthly income. And then we may have a client that comes in, or a couple that comes in, that has 1.5, and they want a lot of income, and it's going to be a struggle, right? So it can go either way. And so I would say that's a great point you make. Don't think that if you're looking at what you have saved or what you have in assets and you think, well, it's too late and there's nothing I can do about it and it's not going to be enough. How do you know until you get a plan together?
Yeah, because I've had that. My financial advisor asked me that question. Well, how much do you need in retirement? Well, that's a great question. I don't know. Right. I guess I've been wanting to save for as much as possible. But, you really got to think about that. I guess anybody does. What do you really need? Right. Can you live off of this amount every month? And think of whatever you want to do. And I think a lot of times people don't think about what they want to do after they retire. They just want to know, I can retire.
Right.
And be happy and not have to struggle, and that part. And that's, I think the more you talk about that, being the age of a lot of our independent contractors, that 55 plus, they still got plenty of time to do it.
They do.
And especially with the money, that's the thing about it. They make a lot of money. So, and I think they just, and a lot of guys, I guarantee you, we got a lot of listeners out here that are way ahead of us. They got it figured out, and they know what they're doing, because I talk to some of them. I mean, they invest and they know what's going on, and they're getting set up to where they can be fine. Whether it's quit driving a truck, maybe not, but I'll drive when I want to drive, and
right.
I work when I want to, how much I want to work, and if I want to take off a couple of weeks, or I can do that, and it's being comfortable, like you said, financially independent, and having those streams, as you call them, of money coming in, so they know they're good for however long. What about, we were thinking about this, and this may go with some of our guys, Scott. So one of the things we do here at Oakley is we have a lot of company drivers that, not with us, but from other companies, they buy a truck to come over here. So they become an independent contractor. So they're leaving a company with benefits that probably had a 401k, some type of retirement. Mm-hmm. What do they do with that when they become an independent contractor over here? Yeah,
so that's we call that an orphaned 401k, right?
Never heard that.
You've left an employer and you left behind the 401k money that you had. And you do have options with that. You can leave it there, which you may want to do. If you are moving to another job, another employer that has a 401k, which in this case you're telling me they're not, that option could be to roll the old 401k into the new 401k. But if that's not an option, that's off the table. But you can also roll it over to an IRA, to a traditional IRA, assuming it's traditional or pre-tax money that's been put into it. A Roth IRA, if it's a Roth 401k, because a lot of companies are offering Roth 401ks as well. And that's a non-taxable event. A direct rollover from the 401k to the IRA is a non-taxable event. You just pick it up out of one account and move it into the other. It will have to come over as cash, because those investments you have in the old 401k can't come with it, all right, and to put it in a simplistic term. So then it comes over in cash to an IRA. You can do that on your own.
Does it come to that SEP IRA?
No, it would go to a traditional
IRA. Okay,
yes.
Gotcha.
So it's very similar, and you could contribute to that traditional IRA as well. That falls into the same category like as the Roth IRA. You could put $6,000 a year in that traditional IRA. But that is a place where you could begin to work with a financial advisor if it's in that type of account. An account could help. That's what we help our clients with a lot, making those rollover decisions, especially those who are walking up on retirement. 401ks tend to be very good growth vehicles, accumulation vehicles. Mm-hmm. They don't tend to be very good distribution vehicles. So when it comes to retirement income, we do see a lot of our clients roll their money from a 401k into an IRA so that they can have the management of a professional financial advisor, and also the advice that goes along with that, and the planning services that go along with that. Okay. So that's an option too. I'll throw the other option in there because regulatory requirements would want me to do this, but it's never a good option. Almost never a good option. You can cash it out. You can take the money out. I really hate to even mention it, but it is an option. But because you're going to pay the taxes on all of it, right? So let's say you've got $100,000 in that old 401k, and you take it all out. Well, $100,000 is going to be added to whatever you make this year. If you did it this year before the end of the year and you made $100,000, now you've made $200,000. So that $100,000 is going to get taxed at the highest federal tax bracket that you're in, because it's all at the upper end of that scale. And then you're going to, if you're not 59 and a half, you're going to get penalized for it, 10% for withdrawal. So you're likely, if you do that, going to end up paying over 30, maybe even closer to 40% of the money, and you may only walk away with $60,000 of it. So that's never really a good idea.
Not at all.
It would have to be a huge emergency.
That
we would ever advise anybody to do that.
That's the last thing you want to do, because you've worked so hard to build that up. You want to that money. I think what a lot of people see. Well, I've got this money in my 401k. I can cash it out. Well, just think. Here's what you need to look at: is if you left it in there,
right?
And if you got another 20 years till you retire, just think how much that would have made you. It's going to help you out a whole lot more than it does right now, and I get it out right now. So.
Right. Well, you think about it. I think of it this way: if you bought something in that 401k when you were 30 years old, and that was 10 years ago, you bought it at a share price that it's never going to probably return to.
Yeah.
Right. So if you get out of it and take it and cash it out, you're never going to be able to get that share price again. Yeah. So, I mean, it is a lot of future growth that goes away.
What's the, I guess, what's the biggest reason people don't plan for retirement? I mean, I don't know, what are they just lazy? I mean, because it's not, I guess we think it's complicated.
I think it depends on the person, but certainly younger people and even people. I'm 48 years old. I think a lot of people in my generation are the same way. We didn't get taught about it. My dad was really the first generation that worked with 401k even being a thing, right? I mean, 401k was created, and I don't know if a lot of people know this, but it's actually the section of the law that created the employer-sponsored plan is Section 401k. So that's why it's called a 401k. Everybody's like, because that doesn't make any sense. Why is it 401k? But it was in the 1970s, the early 1970s. So you're only talking about these employer-sponsored plans being around for about 50 years, okay? So the generation before that was used to working for a company, being loyal to that company for their whole lives, and getting a pension and their gold watch when they left. And so they never taught their kids about, well, those pensions are going to go away. This is on your own. I think we have not caught up with the times very easily when we teach our kids that retirement's on us.
Yep.
Nobody's going to do it for us. If you're going to rely on Social Security, that's a bad formula as well, because we know a lot of people are probably familiar with the problems with Social Security and what that may look like. But it's not going to be enough even if you get it all the way through your retirement. So I think there's this lack of education for part of it. And then I think a lot of it is people don't really envision it. It's hard to envision what life's going to be like in that third act. And sometimes it's not even a happy thought. My dad only, we'll get this in the client room a lot. Well, my dad died at 62, so I'm not even going to have a retirement because I'm going to die at 62. We think that whatever our dad died at is how long we're going to live, right? And that may or may not be true. We're living longer. I mean, you could live a life to 90 years old, but there's probably going to be a time where you're not going to drive a truck for 90 until you're 90, right? So you have to have a plan for, even if you don't want to retire, someday you're probably going to have to. So I think it's the lack of vision. It's hard to really envision what it's going to look like, and the lack of education. And then I guess the other thing I would say is the social mentality that we've gotten to now, where we don't really have attention spans. It's the here and now. We buy what we want right when we want it. We're inundated with those messages every day. So there's not a lot that's in our face that's telling us, hold off on buying that car, and don't get that 6-year, 7-year note to pay for it.
Right.
Put that money into investments instead. There's not a lot of messaging that says that to people.
I know it seems like, I mean, and I guess everybody's like that, but they get excited to go in debt. That's not a good
right.
That's not a good plan, you
Yes.
know, to go in debt. You want to try to get out as quick as possible, but it's also, you don't want to. You want to live,
Right.
You want to enjoy life.
Yeah, it's a balance.
It's a balance you have to do, but still, like you said, there's nobody in front of you going, no, you better wait on that. Don't you don't have to have that right now. I do that enough myself. Beat myself up thinking I go to the store and I'm going in there and I'd like to have that. And I pick it up, put it in the basket. Think, man, that's going to be all right. And by the time I get to the checkout, I've done put it back up and go, no, do I really need that? I don't need that.
Right.
I'm my own worst enemy on some of that stuff like that. But, it's I think it's what you try to envision is not just, it's not about becoming rich, and having more money than the neighbor. I think it's just about being comfortable and no worries, about what happens. Financially, I'm good. If we need something, my family needs something, you want to be able to feel comfortable like that. And that's, I think you're right when people are not educated, to do that. I never thought about that till you said that, being educated to do that, because now I'm working on my boys. It's simple if you're young. Look, guys, all you got to do is put in a couple $100 a month. Forget it.
Right.
And you'll be there one day, and it's hard to, drill that in their brain that it is that simple based on historic, stock market and stuff. But getting them to do it's a whole nother thing. So a little bit of recap for independent contractors. Some of the easy things to do. That's not too late for you guys if you're wanting to retire and you're wanting to. I got to quit saying retire. What do you call it? Financial
independence.
Financial
I do it too. We say it all the time.
You got to be financially independent,
Yeah.
guys, and we want to help you do that here. And Scott Inman with Genwell Financial is giving us some good advice. And so, of course, I think one of the first things I'll throw out there is debt free. Any way you can get debt free, you're going to be a whole lot happier. But a couple of other things you said that they could start doing to recap.
Yeah, so I think I would say the first thing you should do is probably find a financial advisor because, the things that we talk about here, I don't want to be too specific because there are people with all sorts of circumstances out there to find out what's right for you. But just to know that the availability is there, that even if you don't have a 401k anymore, to talk to your drivers that came from a corporate situation and now they're an independent contractor, there's still ways to get money in, benefit now on your taxes, and benefit later in retirement. We talked about the SEP IRA. You can put in an employer contribution based on what you're paying yourself of 25% of the income in an annual year or in a year, and that can go in and help your taxable income now and also help your retirement later. There's also the solo 401k that's a little more complicated that we talked about. You definitely need an advisor to help you there because there's recording and reporting that goes along with that and some more expense, but there is the potential to get more money in if you're really wanting to run hard at it. But the simplest way also is to just look at a Roth IRA. There are some income limits on that. If you make too much money, you can't get that into a Roth, but a Roth IRA gives you tax-free money in retirement, and that's obviously a good thing. Doesn't give you a tax benefit now, but it would give you a tax benefit later in retirement. So those are a few accounts, and I would encourage people to get with an advisor, see what's best for them to start running hard at preparing for financial independence.
Do you run into a lot of people, Scott, that do their own?
Yeah, I think so. I think that we're the first advisor a lot of people have worked with, yes.
It seems like I've talked to some of our guys, and they invest their own. They're playing the stock market, type of deal. And I know you got to be kind of careful when you're doing that, but because I think probably what you advise is long-term growth.
Yep.
Long-term growth, and sometimes these guys get in there it kind of exploded during COVID. A lot of people got into doing the stock market.
I think we phrase it like this. That's if you're trading stocks on a daily basis, you're chasing a return, right? You're trying to see the best return you can get, and that's your focus. We would say we're more outcome based. There's a difference, right? There's making some assumptions and taking on only the amount of risk you need to take on to reach the outcome you're trying to achieve. So that gets the focus off of rate of return. Certainly we want great rates of return. I'm not saying that we don't. But to solely focus on chasing the hottest stock tip, so that you can get the most return on your money. I will say this. I think that people we've found when we hear those stories and they come in and tell us about that, it's kind of like the folks that go to a casino and then they have a really big day. They don't tell you about the 10 bad ones they had.
Right.
They tell you about the one big score they made. And I think that inevitably, if we really look back at all those stock tradings you did, you're going to tell me about the one you got 200% on.
You're right.
You're not really going to tell me about the ones that tanked, right? So overall, are you really even doing as good as you think you're doing, I guess, is what I would say.
Yeah, I think so too. That's something I stay out of.
Yeah.
You know, I'm in the long term, but getting over there, I turned 50 this year, so it's getting shorter than I thought.
Well,
seems like
you're eligible for the catch-up
yeah.
contributions.
Oh yeah,
There
yeah.
you go.
It's always a plus when you turn 50. Golly, I can't believe I'm 50. So, anything else you'd like to add? I can't say enough about you coming over here and helping our guys be successful. I mean, that's the plan, is to give them good information so where they can make good decisions, be successful, you know, and make it. Anything else you'd like to add to these owner-operators out there?
Well, I'd throw out a phone number and an email for us.
Yeah,
if anybody wants to begin
Sure.
asking some questions.
Oh, tell them about your radio show.
Yeah, and we have a radio show too. It's on a podcast too. It's actually on the radio here locally in Little Rock in Central Arkansas. You can catch it on 103.7 The Buzz. It airs on Saturday mornings at 10 a.m. But that same radio show is also available on podcast. So anywhere you get your podcast, probably the same places that you get this one, you can get it. It's called the Get Ready for the Future Show. And it's all about your money, your finances, your retirement, or your financial independence, as we like to say. So catch that anytime you want to get some more education on that. If you want to sit down with a Gen Wealth advisor, it's free to do that. I will say that too. That first meeting is free. We're not going to charge you for our time.
Good.
It usually takes a couple of hours to sit down and discuss your goals, and we ask you bring certain information. Anna Olive is our client introductory specialist. She'll get in touch with you to ask those questions or tell you what to bring. But our number is 501-653-7355. That's our main office in Bryant, but it'll get you connected with an advisor if you want to meet in Little Rock, Conway, Hot Springs, El Dorado, Bossier City, Middle Tennessee, anywhere you're listening close to those offices, an advisor's ready for you. Or you can email info@getreadyforthefuture.com. It is the longest email address in America.
What's that? What's the website?
Getreadyforthefuture.com.
Okay,
We're all about ready for the
Get
future.
ready for the future. That's
Yes.
great. That's a good time. I mean, that's a good title though, and that's a great radio show. I listen to it once in a while too on Saturdays.
We appreciate that.
Oh yeah, and I'd suggest. I noticed I went to your website and you have all the past episodes.
Yeah.
You know, radio shows that you can go in there and watch or listen to. So I recommend, people go in there and check that out.
And we try to make it thematic, so there are topics that we do a whole show on.
Yeah, I saw that.
It hopefully you can find one in there that you really want to know more about.
Yeah, good stuff, man. Well, thank you for coming and helping give us good information for our guys, financial information that they need. And I sure encourage all our owner operators to check it out, and anybody listening, of course. And also with the Oakley Podcast, Trucking Business Family, that's what we are. And we want you to share it with everybody. Spread the word about the podcast and Oakley Trucking and what we do here. We just we try to help owner operators be successful here at Oakley Trucking. And also check out some of our past episodes. We got some good stuff too on there that will help give you some information about what's going on here at Oakley Trucking. Once again, hey, we come out every Wednesday with a new episode, and we'll talk to you again. Thanks for listening.